Hi, well, welcome back to another of these presentations. It's Mark Fielding Pritchard here from AMU Fielding Company, and we are looking today at inventories. Now, those of you who visited our website, and please, I hope you've all visited our website, will know that our historic focus has been on IPSAS, but I think that everything that we're going to talk about, or almost everything we're going to talk about today, will also be relevant for IFRS, because the IPSAS and IFRS are very, very similar. Where you do get differences is the point when we're valuing stock or valuing our inventory at the lower of cost or net realizable value. And the question is, where do we bring in elements of cost? In a government situation, it's much more complicated because you may have things like a stock of shirts for distribution to police officers and so on. Those things will have, or it may be very difficult to calculate the cost for. So there are some differences there, but basically everything in this presentation, and this, remember, is IPSAS, this is IPSAS 12 Inventories 1. There's actually another 3 presentations that come after this. So we'll go into more depth. If you are watching this and you are interested, please go to the website, contact us, and we'll give you access to the other 3 as well, though they will be coming. So the point of this IPSAS number 1 is to, as it says on the slide, and you can read this as well as I can, to understand the major challenges, the major changes, and the benefits related to IPSAS number 12. And there's our website. Please go to the website. Thank you. So slide number 2 neatly sets out what you will be able to do, or we hope you'll be able to do after this presentation. Identify examples of inventories. I have to say that as a theoretical subject, inventory is very simple or very easy. There's very little in the theory of inventory that's going to give you any problems. Now, where you do get problems is in real life and practice, because identifying what is inventory, so what's the difference between inventory and a fixed asset, can be very, very difficult. Also, who has control over inventory, so what's yours and what belongs to someone else. For those of you who are studying ACCA, Chartered Accountancy, be it English or Scottish, CIMA, then you'll be looking at things like consignment stock and so on. So looking at the actual ownership. So we'll come on to those things. If not in inventories 1, then remember that there's inventories 2, 3, and 4 to watch as well, which will give you all the information that you need. We'll also go on and talk about the elements of cost, and then identify the point of expense recognition. So at what point does the thing become an expense in our income statement? So those are the aims of the course. As I said, there are 4 lectures on inventories. This is only inventory 1. Okay, so the benefits of adopting IPSAS 12 inventory is the title of the slide. Now, some of you may be thinking, well, what on earth is this about? We have to do this. Well, the point is that you don't. Historically, governments, United Nations and so on, before IPSAS adoption, used cash accounting. Now, if you look at cash accounting, there is no requirement for you actually to put a value on your inventory. If you purchase some goods, it's an expense. If you have something which has some element of overhead, then you're paying for those overheads in addition, and there is no way of including those in the value of inventory because you don't have any inventory. Now, many governments, if we look at my background, so in Russia under Soviet accounting, they had inventories and they kept inventories at values. So for most governments, it's not strictly true to say that they had no inventory. But as a point of principle, they didn't have to do this. How they calculated the value was up to them. And for many organizations in places like the United Nations and NATO and so on, they just didn't bother to keep inventories. Right, therefore, the benefits of adopting inventory. So it's this idea of having an inventory compared to not having an inventory. So identification of the economic value of the asset owned by the organization. What a wonderful phrase. Right, what it means is that you have a value for your stock. So there is a value with a number of dollars or pounds or Swiss francs, whatever your currency is attached to it. So now we have an asset, and that asset has a monetary value. It just gets better, doesn't it? Reporting expenses as the value of inputs used in provision of core services. Right, I think we need to start at the end of that. Core services. Bearing in mind that we're dealing with government. So government is providing a core service. So let's assume that you're looking at the Ministry of Transport or something. It will therefore have a certain amount of inventory that relates to the building of roads, a certain amount of inventory that relates to the provision of state-funded bus services and so on. So therefore you can see by expense group or expense heading the value of what you've spent and the value of what the money's been spent, but you haven't used the asset yet. In other words, what's the value of your inventory? So therefore, for most government, for segmental reporting, we will have inventory for each major core service. Number 3, identification of the mix of resources, long and current, used by an organization in providing its core services. Right, so once again, we've got this idea of core services. Long-term resources are what we would call fixed assets, or property, plant and equipment. So therefore we have this split between long-term resources, so our fixed assets, our motor vehicles, our buildings and so on, and our current assets being our receivables, being our inventory, being our cash and so on. So for each of the core services under segmental reporting, assuming here that we're basically producing a balance sheet for each core service, you can see the split between long-term and short-term. Number 4, now we're getting into standard IFAC. What's the benefits of IPSAS speak? So creation of high quality and more credible financial reports. You kind of have to be honest, it does. You know, if you're buying a massive amount of goods, like you buy 25 million shirts for your policeman and then you hand out 10,000, your cash accounting just simply shows you've bought that many shirts. It doesn't tell you whether you've given the things away or not, or whether they're actually in use, whereas now under IPSAS 12 it does. So therefore, it is true, you do get higher quality and more credible financial reports. And finally, facilitation of comparability with other organizations. Gosh, another wonderful phrase. Right, you can now compare the Ministry of Transport with the Ministry of Education, and you can compare the government of Kazakhstan with the government of Argentina, and so on, insofar as you want to. There is no doubt that this is a huge improvement over cash accounting, which shows, in principle, no inventories at all. Because if you buy stuff and don't use it, you can't see that from a set of accounts. And the other thing is, lots of different organizations have their own ways of valuing their stock, their inventory. So therefore, there was no way of comparison. You know, you value these things at the lower of cost of your grandma's age or something. And we see some very strange systems being built around the world, particularly when you come to things like biological assets and things like livestock for agriculture. Okay. So what we've moved on to here is some kind of pseudo definitions, and you can see that you've got words in bold and words that are underlined there. So it tells us that inventories are assets that are, number 1 here is materials or supplies that are to be consumed in the rendering of services. Right, what this word in English language, consumed, means therefore is that these things are like to be taken and kind of eaten up. So it's like making a telephone call. Let's assume that you call your mother, you call her for an hour and it costs you $2. That's it. You've called her, it's gone, it's over, as a cost of $2. And as an object, that telephone call is done and dusted, it's gone, it's finished. Now compare that to the physical telephone itself, the actual apparatus that you hold in your hands. You called your mother, but it's not gone, it's not dead. You can use it again in the future and again, and that will last you for some days, some months, some weeks, some years, depending on how rough you are on your telephone. And that's the difference here. And that's really what this part is about, is what is the difference between a current asset and a long-term asset. And a current asset is one which will be used within 12 months, and it will be used probably almost certainly once and it will be gone, as opposed to some asset that has a life which spreads over a number of accounting periods. You know, long-term assets, buildings, motor cars, fridges, telephones, tables, these things have a life that we measure in years, as opposed to a chocolate bar that, if it's in my house with my children, it has a lifespan measured in minutes and seconds rather than anything longer. So therefore, inventories are assets that are the short term in nature. So we have fuel, rations here, I'm guessing this is coming from the United Nations. So rations here, that means food, maintenance materials, so this is maintenance for motor vehicles and so on, spare parts and accessories. Remember, if this is maintenance materials for motor vehicles or spare parts for motor vehicles, the vehicle itself will be a long-term asset, a fixed asset. The maintenance materials and the spare parts are short-term. Materials or supplies to be distributed, so food and non-food items. So this is stuff which is to be distributed. If you have it in your hands and you give it to someone else, it's gone. Yeah. So that the thing is gone. Remember that motor vehicles are long-term assets for you, but in the hands of a motor dealership, they're inventory. Because he buys his Mercedes-Benz and 2 weeks later the thing's off the lot and it's gone into someone else's hands here. And it's the same thing here. This stuff comes to you and boom, it's gone away. Yeah. So this is just an extension of the example, and it just follows on from slide number 4. So items which are held for sale in the ordinary course of operations are in the process of production for sale or distribution. Books and publications, educational materials, it's anything which your government is holding with a view to selling in the future. So therefore anything which they are holding and they're selling, and in some normal kind of business. If you look, for example, at the British government has many commercial arms. So HMSO, which is Her Majesty's Statistics Office, which sells books, and those books are books of statistics which you can buy on levels of employment and all the kind of stuff that the government gathers and produces itself. Those books will be stock or inventory. And finally, materials or supplies to be consumed in the production process. Certainly it depends on how active your government is, but as you move kind of east, you'll find that the government's become more active. Certainly when I was working in Russia, the government there had contracts with certain factories, and they actually owned the factories, and the factories were producing boots for the army, shirts for the police, producing driving licenses, for example. So if you have stock of plastic cards that have not yet been printed on, which you use for driving licenses, that was a big one for us as far as impairment went in Moscow. So those kind of things as well. Get back to this idea, is it something that we will hold in the short term and it will be gone, or is it long term? If it's long term, property and equipment, think. Short term, it's inventories. And here you go, more again. So inventories are materials and supplies to be consumed in production or rendering of services, expected to be used, sold, distributed, current assets, and accounted for under IPSAS 12. Property, plant, and equipment held for use in production, so therefore this idea that they last much longer. They are non-current because they will last for more than one accounting period, and they are accounted for under IPSAS 17. It's kind of just a summary. It's one of these kind of things as well that, you look at this and you go, oh my god, that's so easy, why is he going on about this? Shut up and move on. But actually, in fact, you'll find that it's not so easy in real life. So at what point does the current asset become a long-term asset, So think about it carefully. If you get the theory, you'll find it not so difficult. So what we're looking at now in slide number 7 is what are the challenges at initial adoption. Remember, with initial adoption, you're going from a cash basis of accounting into an accrual basis of accounting. So the first two things kind of go hand in hand, and in fact all of these things are kind of linked together, but let's try and put them in some sort of order. So the first thing is obtaining the beginning balances, and pretty much everything here is related to that very difficult task. So a detailed survey of existing inventories. Right, now this actually requires you therefore to work out what you've actually got in inventory. So what actually is there in your warehouses. Now, if you're WHO or someone, you've got enormous warehouses full of medicines spread all across the world. Now, how do you actually go around and do a stock take of every single inventory item that you own? That is going to be a very, very large item. And what you really need to think about as well here is obviously you've got to train the people, but it's the coordination of the people as well. Making sure that they have proper lists, and when I say proper lists, I mean proper instructions in terms of what is it you're actually doing, and making sure that they have proper recording systems, because if you don't get this right, it's one of these kind of things that people are going to lose heart very, very quickly. It's something as well, when you do it for the very first time, you need to get the buy-in of everybody, because if you can get 100 people working on a warehouse, they probably work for a day and it's done and it's a bit of a laugh and you go for a beer after. If you give it to 5 people, you're talking about a month's work, and they'll kind of drift off if they have other jobs and tasks to do as well. So this idea of a detailed survey of existing inventories, and it has to be done. And the problem with this as well is that unlike many things in IPSAS implementation, it's not only done once. Once you've done it once, you have to do it every month, every 6 months, every 12 months, whatever your stock taking policy is. So it's not something that's going to go away. It does tend to be one of those things where I guess it can be quite good fun, or at least you get some good stories out of it. I certainly had colleagues training in Scotland who ended up doing stock takes, counting sheep on dark hillsides in the middle of Scotland at 12 o'clock on New Year's night. But it's something that you do need to manage very, very carefully, and there's a big human element with this. Valuation and coding of existing inventories. Right, the first one there is valuation, and this can be difficult. How do you actually go back and find the value of what you've got? Particularly when you've got things like reservoirs of liquids, because you need to work out what it actually is that you've got, where it come from, what's still there, what's gone already, and so on. So how do we actually put a value on it, and how do we make sure that that value is correct and is consistent? It tends to be easy going forward, because once the system is in place, then you're kind of okay. In terms of the coding as well, at that stage you need to understand within your ERP system how you code your expenses, and how therefore some of those expenses will feed into the value of your inventory. Bearing in mind that these things have been treated as expenses under the previous accounting system as well, you're going to have to make an adjustment in your opening IPSAS balance for them. Decisions on accounting and reporting policies. Reporting policies are not usually so hard. It kind of goes hand in hand with the last part, which is classes of inventories, but it's not usually a huge decision. Accounting policies become harder because if you have inventory which is being produced, you're supposed to include all of the direct costs, so your direct materials, your direct labor, your direct overhead. The question is that is not a black and white decision. What is a direct overhead and what is not a direct overhead? So you need to go through your costs one by one and get the whole team to agree on what is included and what is not included. That is a huge job, because you have to identify what all of those things are from your chart of accounts. Then, having identified what they are, you have to work out the system or the basis on which you're paying them, and then deciding what goes in and what doesn't go in, and you're always going to have disagreements. So you have a big job to do there. So decisions on accounting policies, how are you actually going to value these things? Very, very difficult indeed. Having said that, you know where our website is. Any advice we can provide, please get in contact. Okay, so on to slide number 8, which I guess really rather logically follows slide 7. But what slide 8 actually does is it gives us a wee bit more detail on the stuff that we were looking at on slide 7. So the first point we've got there is policies on costing. Right, with policies on costing, and bearing in mind the heading of this slide is challenges at initial adoption of IPSAS. So remembering that you're going from cash accounting into accrual accounting. Therefore, we're introducing the concept overall of inventory. So how do we cost or how do we value? Bearing in mind that cost, the value of our inventory is supposed to be the lower of cost on net realizable value. What goes into the cost? Well, you'll have to decide that. If you look at any textbook, it will tell you it's the cost of bringing it to the warehouse plus the cost of the goods itself plus any supplementary work. Or if you're manufacturing, it's direct materials, direct labour and direct overhead. Well, as far as textbook production goes, that's a nice short little explanation. And the theory is fairly black and white. Moving from the theory into the practice, I'm afraid it really is not that easy to calculate what those things are. And in fact, assuming that your financial accounting system and your management accounting systems are linked, you're going to have to go through your chart of accounts, and then you're actually going to have to work out what you're going to include and what you're not going to include. And that's going to have to be at the policy level, and then that is going to have to be taken down to the next level below when you actually do some account mapping and saying what goes in and what doesn't. And as I said, you're going to have to do it as a team and agree as a team where you go with that, because it won't be as black and white as it seems. So that's your costing policies, what goes into the cost, what doesn't go into the cost, and it's a discussion and negotiation process. The second one in our list here is the inventory system. Right, the inventory system, we kind of look at that usually in two ways. First of all is how often do we do inventory counts. Inventory counts, therefore, the old traditional way back in the sort of 1950s was that you did them once a year on the 31st of December.
or at least on the last day of your financial year. And that works, I suppose, fairly well where you have relatively low value items, or they're really relatively easy to actually calculate. More modern updated systems would be the kind of idea where we have perpetual inventory systems. Perpetual inventory systems give you a perpetual note of what's actually sitting in your inventory, and you should be able to check those any day. If you want to see one of those systems actually working, the best way to go and do it is have a look in a supermarket. When something comes into the warehouse, it's usually the way that most supermarkets work is there is a central warehouse which feeds out into a number of individual stores. So in your store, if we just look at the store as a standalone item, when the goods come in from the central warehouse, then they're treated as in, and at that point they're scanned and barcoded and shown in, and they're in the warehouse. And then when you purchase the goods, then what happens is when you take them to the till in your supermarket, they put them under that machine that goes bip, and that deducts them from the stock. And then the staff of the stock will make similar adjustments through a barcoding process for those items which are either damaged or items which are disposed of because they go out of date or out of code. So this idea of a perpetual inventory system. The alternative to that is this idea of counting stock. Once a year was the old idea. Places like banks, for example, will still have a stock count every day. Their stock, of course, is money, and they do it every single day. They'll count the cash in the morning, and they'll count the cash in the evening as well. So you've got this idea of inventory systems, first of all, perpetual stock systems, or periodic counts. Now, it may be that under your cash system you had an inventory system and you had these stock counts, but you're going to have to solidify that system. In other words, you're going to have to make sure that the system matches your accounting needs. The second thing that you're going to have to look at, and this ties in with the one below in warehouse management. When you come later on, we're going to look at different ways of measuring the value of our stock. So in other words, there's going to be FIFO, LIFO, and weighted average. So FIFO, for example, means that the goods which come in first are the goods which are treated in accounting terms as going out first. Now, we use FIFO as the most common in real life, particularly in things like the fashion industry, the food industry, anything where timing, what comes in first, has to go out first. It may be, therefore, that you have to completely change your whole warehouse management system so that your warehouse, in fact, does that. So you have this idea that goods come in and they come in at the back of the warehouse and they systematically move to the front as they get used up. Again, with those kinds of items, it will depend what their shelf lives are as well. Again, if you've got fresh fruit or something, you'd be wanting to turn these things around. They're coming in the morning, and you'll be hoping that most of them have gone out that day. When you come to fashion items and things, well, they have a season, so you're then looking at 3 months that these items might be sitting in your stock. But warehouse management becomes very important. Other things as well in the 21st century as modern communications that's important is people copywriting or people breaking copyrights. In certain industries like the fashion industry and the jewellery industry now, they only make one batch of goods. Those goods are manufactured, they're in the shops. By the time that copies of them have been sent back to foreign countries that don't have particularly strict copyright laws, you've already got fresh stock coming into your warehouse, so you're always one step ahead of the people who are taking your ideas. So therefore, tying in with this whole idea, therefore, stock taking or physical verification that we've got here, process and working re-engineering, your physical processes are really what's important, in fact, and your accounting processes, therefore, should mirror them, and the two things should work in tandem again. I would think now, by the time it's the 21st century, even in organisations that are, government-owned manufacturing shirts for the police and so on, where you're guaranteed that your stock manufacturing and your cost tracking methods should be up to date. But you need to make sure that all of these things are done. I have to say, in fact, I sounded very confident when I said that in many countries that they're not, in third world countries, and also in places that you might not expect. So therefore, this is a very good opportunity, and it's a very good example of where we see IPSAS being used as something, as a tool to bring in worldwide best practices and the best kinds of things that we can do to upgrade. IPSAS itself tells you how to present your accounts, but now you see us upgrading our HR our HR methods, the recording methods, our hiring methods. Now you see us looking at warehouse management, and IPSAS is this tool which we can use very effectively to bring these things up to date. Right, so those are the main areas therefore. So therefore, in terms of getting it clear in your mind, just think about how your warehouse is going to work. We can have FIFO, we can have LIFO, and you need to go onto our website and find out what that is if you don't know what it is. Secondly, are we going therefore to have periodic stock takes? Are we going to have daily, weekly, monthly stock takes? Or this concept of perpetual, and even if you have perpetual, you still at certain points in time have to do this. Finally, to make sure that everyone understands all aspects of this, we've got this idea of training and communication. Remember, again, for governments, you're going to likely be in remote locations. You know, how do you count the number of bullets and stuff in military bases that are on borders and so forth? So you also need to plan into this communications and training, and making sure that your training and communications, your training specifically, covers all aspects of inventory and how to count them and how to value them and so on. It is, in textbook terms, a very short, a very easy topic. It is in practice an incredibly complicated topic. Imagine calculating the value of stock for an entire country. And then in countries where we did it, we had forms of, well, actually very loose forms of geological reports that told us that there were certain types of metals under the ground, but the ground had never even been surveyed properly. So how are you going to put a value on that? If you have any issues, you have the name of the website, please contact us through the website. Right, there you go. That's the end of that. That is lecture number 1 or course number 1 of 4. So it goes inventory 1, 2, 3 and 4. Please come onto our website. Ask us how you can get hold of courses 2, 3 and 4. If you need any help, please, you know where we are. And there's a picture of me so you know who you're talking to on the end of your email as well. Thank you very much for listening. Anything we can help you with, please contact us. And remember, this is all relevant for IFRS, this is all relevant for ACCA, this is all relevant for Institute of Chartered Accountants, England and Wales, and Scotland as well. Okay, I hope you enjoyed it. Bye bye now. Please remember as well, if you enjoyed this, pass it on to someone else. Come and friend us on Facebook. Come and follow us on Twitter. You know all the stuff all the websites ask you to do now. All the best. Bye bye now.